Good afternoon, everybody. Thank you for joining us today for our weekly TRU Snacks webinar session. This week, we'll be talking about PPP round 2. I'm sure top of mind for all of our attendees today. I'd like to go through a few little admin items before we get started. The first one is the Q&A window will be open throughout the chat. Given the conciseness of these webinars, we would encourage you to ask your questions as we go. If they're relevant to the topics that we're talking about right then, we'll work them into the conversation. Otherwise, we will save time at the end for Q&A. Given the attendance today, we will look to get through our content and the beginning of Q&A within our typical 30-minute window, but we may decide to go over a little late if there are extra questions. So we want to be able to address as many as possible. We'd like to remind you that these webinars are held exclusively for members of our database. So we encourage everybody to sign up for our mailing list in order to get these invites every week, as well as special bulletins. Our links will be shared by email after the session, and you can also go to the link that's on the screen right now. And we'd also like to remind you that all sessions are posted on our website. On our TRU Snacks page, you can watch webinar replays, summaries, and get access to the content on our website. So I encourage you to go to citrincooperman.com and look for TRU Snacks on our In Focus page to get access to all of our content. Again, these sessions are run once a week on Thursdays at 12 o'clock. We have new topics every week, new speakers, and are always trying to keep things fresh and relevant for the audience. So we encourage you to sign up. The only other admin item that I'd like to cover before handing it over is we will do our typical random drawing for our exclusive craft snacks basket. It's always a popular item every week. So as we go through today, a winner will be chosen and somebody from our team will be reaching out to you to get shipping information for that after the call. So without further ado, let's get into our content for today on PPP round 2. I'd like to introduce Mike Zaborovich, a partner of mine out of our Philadelphia office and one of the leads of our PPP content series. Mike's going to be walking us through the changes of PPP today and taking your questions as well. Looking forward to a lively discussion and taking all your questions. So Mike, over to you.
Thank you, Steve, and welcome everybody. And certainly a hot topic, but really a pleasure to be on this webinar series, as Steve mentioned. A lot of great content here, so really suggest you check out the previous recordings and certainly sign up for future ones. PPP is a hot topic right now, but I think a lot of the information that we disseminate in this webinar series, certainly goes much more long term than the PPP. But so we have a lot to cover, in this webinar. So we're going to go through it rather quickly. Certainly post your questions, and as Steve mentioned, if we run a little long, we're willing to stay on to answer as many questions as we can. But there is a lot of topics. So again, my goal here is to run through an overview of the rules and changes and highlight some of the issues that we've been seeing with our clients over the past couple of weeks as this began to roll out. So next slide, please. So the areas that we're going to cover the PPP second draw, whose eligibility of it, how to calculate it, and what documentation you're going to need to submit. We're going to talk about the PPP first draw, which is also reopened, and then so you can get a first draw loan if you didn't get it the first time around, or you can increase the loan if you got it, if you're eligible for. And we're going to briefly touch on the employee retention tax credit because it is relevant and is now open to PPP borrowers as well. But again, that's very in depth. We're just going to go real high level and then break into Q&A. So next slide, please. All right, so you heard about the second draw PPP. Now it's determining, are you eligible? So we're going to just go through the criteria to be eligible. And it's all of these criteria essentially. So first things first, you have to have applied for and received a PPP 1 loan in order to be eligible for PPP 2. This is key because, if you didn't get a first draw loan, again, the first round, and we're going to touch on that later on, is open to it, but you had to have applied and gotten a first round loan. Not only that, you had to have used that amount on authorized expenses, eligible expenses, prior to the date of getting the second PPP loan. So this kind of opens up a couple of questions. It is that you spent the money. It's not necessarily that you've gotten forgiveness. We've had questions from people saying, hey, my first loan wasn't forgiven. Does that mean I'm ineligible for the second loan? Not necessarily. Well, generally, no. It's not forgiveness. It's what you spend. It's also, you might have spent the funds after the covered period. And I think that seems okay too. Where you have to be careful is you spend it on eligible expenses and you follow the criteria. So an example was given in one of the interim final rules. Let's say, you spend all your PPP funds on rent or lease. You own a parking lot business by the airport and you were shut down and you had no employees. That wouldn't really count as eligible expenses according to interim final rules. So you would have to follow the 60-40 rule, payroll versus non-payroll bifurcation in order for the expenses to be eligible. It has to be a hard count of 300 employees or less. That includes your affiliates. The affiliation waivers do apply for anybody, any organizations with a NAICS code starting with 7.2 or franchises. Those are exempt from this rule. And in those instances, it's 300 by or less by locations. It is a hard head count. The head count can be calculated a couple different ways. It could be average head count for the trailing 12 months leading up to the loan application date, or it could be average head count for the one of the look back periods as well. Right now, it does not appear. Now for PPP1, one of the major differences was that there were alternative size standards, whether it was for the industry or just a general alternative size standard, which created the ability for larger companies with larger, with more than 500 employees for round one, 300 for round two, to be able to access these funds. It does not appear like the alternative size standards are applicable, but again, we're still waiting on final guidance on that. Next is, gross receipts have to have. There had to have been a decline of more than 25% in one of the calendar quarters in 2020 as compared to that same calendar quarter in 2019. So it could be Q2 2020 versus Q2 2019, Q3 2020 versus Q3 2019. And again, it's a matter of comparing the same quarter. And then, you have to factor in your affiliates as well. So when we talk about affiliation is generally common, ownership of more than 50% or common control. And again, this kind of goes down. There's a lot of different variations of this, and so this sometimes gets into legal territories. But certainly, if you have questions regarding affiliations, please put it in the Q&A, and we can discuss that as well. But you have to factor in you and your affiliates for the 25% gross receipts. So if you have commonly controlled entities, you combine them together, figure out whether a quarter compared to that same quarter in 2019, you had a 25% drop. Also individually, so you have to be there in combination and likely individually as well. So in those instances, it's important to take that into consideration. We have a lot of questions about gross receipts and what are gross receipts. So what I'll do is I'll read you the kind of the explanation for gross receipts or the definition for gross receipts, and it's defined as all revenue in whatever form received or accrued in accordance with the entity's accounting methods. And then it goes on to define what those what's included and what's not included. What's not included is sales tax collected. Intercompany, if you have affiliates, intercompany revenue can be excluded, but generally on most forms of revenue. And then again, it talks about, received or accrued. That means cash or accrued. So some people, it's depending on how you keep your books. Now, if you keep it in both methods, cash and accrued, then, ultimately, you should be okay to kind of pick and choose whichever one, works for you. We'll talk about what documentation you need to provide to support that 25% drop. And then again, that'll be dictated by which method you use. So if we then look at the next item, you have to be in operations. I'm sorry, go back a slide. Sorry. You have to be in operations as of February 15th, and you cannot be permanently closed. So a lot of questions come up with as far as, well, I opened in first quarter 2020, but before February 15th, then you would be eligible. You would have to compare Q1 2020 to Q4 2020 for that 25% drop. And then last one is the current economic uncertainty makes the loan request necessary to support ongoing operations. This is the same certification that you had to make for PPP-1. It is something that I would suggest you speak to your legal counsel about to make sure you are on safe footing. If you're sitting on $10 million in cash with no offsetting debt, I think you'd have a hard time making that certification. But again, each circumstances, dictate, whether or not you would qualify under that certification. Again, it gets into more of a legal realm, and so we would suggest that you reach out to to your legal counsel. Based on this, Steve, I think one of the questions that came up can consist of any consecutive months. The answer to that is it doesn't appear that that is the case. The examples and the guidance have mentioned specific calendar quarters. In instances when we talk about seasonality, you can pick any 12 weeks. And so they make that differentiation. And so I would say calendar quarter comparison. If we keep financials on an accrual method and report tax expenses on the cash method, can we choose either method? The answer is yes. And in general, if you're keeping your books on an accrual method, I don't think that it's logical to then convert all your quarters into cash methods to determine, to essentially determine if you had a 25% drop. So yeah, I think you can use whichever one, in that case. All right, next slide. So now you know who can qualify, who can't qualify. Publicly traded companies cannot qualify. Hedge funds or private equity firms. If you are a hedge fund or private equity firm, you cannot. If you're a management of a private equity firm, that's a different question, and that that necessarily hasn't been resolved. But if you are owned or you have ownership by a private equity firm, you are not disqualified. However, this gets into kind of liquidity and necessity issues, meaning that if you have access to cash that other people wouldn't because you're owned by a private equity firm, do you really need the PPP loan? And that kind of gets into that certification that we touched on last. And we give a couple of examples. If you received certain shuttered venue operating grants and some other grants, if you have ownership or board members from Chinese held entities, or you sit on the board, or we have a Chinese resident on the board, you would not be eligible as well. So that's who's not eligible and who is eligible. Next slide, please. All right, so now you know whether you're eligible or not eligible for the second draw. How do you calculate the loan? Again, it's a similar calculation with a lower threshold. So it's essentially 2.5 times for most companies, 2.5 times your average monthly payroll costs over one of the calendar periods. It's either 2019, you can use 2020, or the 1 year before the date of the application. Not to confuse anybody, you can pick and choose whichever one you want to use. For most people, I think calendar year 2019 is most beneficial. And again, it's 2.5 times that. So you take that number or $2 million. $2 million is a threshold opposed to 3 or 10 million in PPP-1. Now, having said that, companies with NAICS code 7.2, starting with 7.2, which is usually restaurant hospitality, they can use a multiplier of 3.5. Now, 3.5 only applies to second draw. So we will be talking about certain things that apply to PPP-1 and PPP-2. This only relates to PPP-2. So if you are applying for PPP-1, you can only use 2.5 times average monthly payroll costs. I would want to say that when you're factoring and calculating that, you do have to cap all individuals at $100,000. So if you have somebody making $200,000, when you're making this calculation, cap them at 100 when figuring out what the average monthly payroll cost is. All right, next slide, please. So now that you have the calculation, you figured out whether you're eligible or not. How do you apply? And what documentation will you need to provide? So essentially, most lenders have their own portals and have their own, criteria for what information to provide. And so if you're applying with the same bank that you applied for PPP-2 or PPP-1, then it's a little bit simpler, right? You are able to They already have your payroll data. If you're using 2019, again, they already have your payroll data. So then the question is, what information do you need to provide to support the reduction of 25%? And so there's a couple different things you can provide. You can provide bank statements. Now, if you're providing bank statements, you're probably going to have to show the deposits that add up to, your revenue on a cash basis, essentially. And then highlight that same comparison to the bank statements, from 2019 for that same quarter. So if you're going to do that, you're going to have to do some work to show the lender that you are down 25%, on a cash basis. Ideally, you have interim financial statements, and again, those can be on an accrual or cash basis, and that show a 25% reduction for a quarter over quarter, 2020 versus that same quarter 2019. And they do give you the option to provide tax returns, and the reason is that and this kind of gets into annual revenue. You can show annual revenue, and if you have a 25% drop for the whole year, right? So because if you have a 25% drop for the whole year, you obviously had at least one quarter with the 25% drop. And so, in that case, you can show probably financial statements and tax returns. The problem there is then not a lot of people have 2020 tax returns filed at this point. So in all likelihood, if you're in a rush, and then we'll talk about, it is kind of first come, first serve at this point. So the tax returns might not be available to you at this point. So, what else changed in the second draw? And then these things all, relate to first draw as well. So you are able to expand your eligible costs. And why would you want to expand non-payroll eligible costs? A couple reasons. One is that maybe you didn't, you weren't able to get there for full forgiveness, just using payroll. So that's one. And two, as we'll talk about, when we talk about the employee retention credit, you cannot double dip and use the same eligible wages for PPP and employee retention credit. So in some cases, if you want to take advantage of both, you might want to limit your payroll costs and then maximize your non-payroll costs. So let's just kind of walk through, and these are the new categories in addition to rent, mortgage interest, and utilities, which were in the original PPP1. These are in additional, these are expanded. So you have the covered operation costs, and this is essentially any software or cloud services that facilitates business operations. So the examples could be payroll systems, HR systems, billing systems, inventory systems. So those costs associated with that can be eligible as non-payroll costs. Property damage costs. So if you had any property damage, vandalisms, or looting related to the public disturbances in 2020 that were not covered by insurance, that could be eligible. I'm going to skip over supplier costs for a second because that's the most complex one. Covered worker protection costs, so PPE, anything like that that you created, barriers or sanitizers, sanitation stuff that was required, or that you implemented as a result to complying with regulations from DHS, CCD, OSHA, that's eligible. And then finally, you have an expansion of non-cash compensation payroll costs. So essentially what that is that you are eligible for employers' portion of group health insurance. They expanded that to include now life and disability insurance as well. Previously, that was not allowed. And so let's talk about supplier costs. It's a very vague category, and definition is payments made to a supplier for goods that are essential to operations of the PPP borrower. It's extremely broad. Does it include inventory? Again, they haven't defined it. They went on to kind of talk about if it was pursuant to a contract, but not necessarily, but it could be pursuant to a prior purchase order or a contract, and possibly perishable goods. So if you're a restaurant and you had orders for food and whatnot, you could have that had spoilage, you could rely on that. And then they clarified that the cover period doesn't have to be 8 or 24 weeks. It could be somewhere in between, but you have to be cognizant that the caps have to be adjusted. So, if you have a max cap on eligible payroll for 24 weeks, you're gonna have to scale that if you use a smaller date. All right, next slide, please. Let's say you didn't get a PPP2, so now you talk about PPP1. You know, and who's eligible for that. Again, it's people that previously didn't receive a PPP-1 draw. If you returned a part, all or part of it, if you were eligible for and you didn't accept the full amount, but again, you probably didn't accept it because, you know, you felt like, you know, you didn't need all of it, and that kind of gets into that certification. So I don't know if something changed because of that. And then if there was rules that changed subsequent to the time where you filed your application. And they gave 3 specific examples. So the seasonality calculation changed after initial guidance was issued for PPP-1. Rules on partners and partnerships changed. And then rules, you know, for farmers and ranchers changed as well. There could have been other rules that changed as well. They just didn't define it. And again, it enables you to open up your PPP-1 draw. Now, what's important is that if you do request an increase, make sure that you had enough expenses in 2020 to cover that, because otherwise you would not have spent of all your PPP-1 draw money, and then you wouldn't be eligible for PPP-2. So you have to be cognizant of that there. Next slide, please. All right, so the last thing that we'll cover, and then, you know, we should have some time for question, is the employee retention credit. And so this is a payroll tax credit that was available for, you know, when PPP-1 came out. However, it was one or the other. You could not have had both, right? So if you chose PPP, the PPP program, you could not take advantage of the employee retention credit, which again is a payroll tax credit. And so now what happened is that the recent act opened it up to everybody, including PPP-1 borrowers. And so there's a couple of considerations here. The credit, real quick, is essentially for, you know, eligible wages, and eligible wages, you know, for the first round of ERC were calculated differently depending on whether you were under 100 employees or over 100 employees, but you were eligible for 50% of the first $10,000 of eligible wages, you know, for employees during the covered period. And the covered period started, you know, in the time where you were affected partially or fully shut down, or had a 50% drop in your gross receipts. And that extended throughout the period where the shutdown, partial or full shutdown ended, or where you economically crossed the 80% threshold when you're comparing 2020 quarter versus 2019 quarter. So for example, you had a 50% drop in Q2 2020, and then you crossed that 80% threshold where you were maybe 90%, you know, only 10% reduction in the fourth quarter. You were able, your covered period for the ERC would be second quarter through the fourth quarter. That changed in the second round, where it expanded. You're now eligible, it's per quarter, and it's up to 70%. And it lowers, you only have to have the 20% reduction. And again, we just want to highlight that, you know, ultimately you cannot utilize the same eligible wages for PPP and employee retention credit. And so there is a strategy, you know, whether it's PPP-1 or PPP-2, that you know, you would want to minimize the payroll costs that you utilize for PPP-1 in order to take advantage of the employee retention credit if you qualify for both. Again, last thing, no rush on employee retention credit because it's based on calculations of quarter over quarter for 21. And again, you have time for that. PPP-1 and PPP-2 is based on a first come, first serve. There's limited funds. And so it is important to kind of keep an eye on that. You don't want to be in a position where you are shut out. And so, you know, that's, you know, generally the priority. So again, a lot to kind of go through. Hopefully we kind of covered it. One thing, so I don't know if there's any other questions, Steve. I know you tried to cover some. I can go into them now.
Yeah, I've got a bunch queued up here, Mike. So yeah,
right.
if you want to cover before we jump into questions, go ahead.
No, that's fine. Let's jump into questions and try to address them.
All right, so we'll start off with a couple of kind of preliminary ones. First is it okay to apply through multiple lenders, especially if people aren't hearing back from everybody that they're applying through?
Yes, and then just be mindful and keep the lenders, let them know that if you received a loan, let's say you're applying with Bank of America and they weren't hearing back from them, so you went through a smaller lender and then Bank of America got back to you, please let that small lender know, just so they can take you off the list. So the answer is yes, you can't take more than one loan, but you can apply obviously with more than one. Just let them know if one goes in before the other.
All right, perfect. Let's talk a little bit about that, the calculation for PPP2. First, can you compare annual revenue for the decrease instead of quarterly if you want to?
Well, if again, the criteria is that you have a quarterly decrease. Now, if you had a 25% decrease for the whole year, then you're obviously going to have one quarter in there. So you would be covered if you had it for the year. But again, the criteria is on a quarterly basis.
All right, can they use the same payroll info that they used to apply for the first loan?
Yes. So if you're with the same lender and you use 2019, then they should already have that information for you. And in that case, I do want to clarify that if your loan is under 150,000, you do not have to provide that reduction information up front. You do have to provide it for forgiveness, but if your loan is under 150,000, you will not have to provide that information, reduction information to the lender up front. Again, each lender has different criteria. So just because they don't have to doesn't mean that the lender is going to ask it. So we have had situations where people have asked for information that isn't necessarily in the guidance, but it's up to the bank.
Got it. All right, so we report financials internally using accrual basis, tax returns or cash. Does tax basis rule for which to use? This is the first time some folks, I guess, are hearing that you can use accrual basis.
Yeah, you can use accrual basis, and you can use an understanding that most people, or keep their books on an accrual basis and then convert it to tax. The guidelines say, you can use whichever one, you generally use. Again, if you have your books in both cash and accrual and you use cash for internal purposes, but maybe accrual for reporting purposes, there isn't a specific deferral, meaning you have to use one first and then otherwise, use two. And it doesn't defer to the tax status, meaning if just because you file your taxes on a cash basis doesn't mean you may keep your books on an accrual basis. So I think you have the option there.
All right. How about unrealized gains? Do unrealized gains on investments count toward the revenue calculation?
I do not believe that they do.
Okay. And let's do one more before the mark here. If you were fiscal year and not calendar year, how do they show quarter over quarter? Is it calendar quarters or fiscal quarters?
I mean, it's again, the guidance seems to be calendar quarters. When you're comparing it, but that might be a question for a lender because they aren't specific. A lot of this is still fairly new. So what happens is they'll come out with the guidance and then subsequent FAQs on this. And so, I think that there's still more to come on a lot of this, especially the expanded cost categories, and what qualifies, what doesn't. And so, certainly be on the lookout for that. And we will certainly report out, if any further clarifications come up.
All right, perfect. So we are at the 12:30 mark. We're going to keep going with questions. So feel free to stay on. The winner of the snack basket will be Stephen Weaver from Atlantic Cape Fisheries. So Stephen, congratulations. Somebody from our team will be reaching out. And then let's jump back into questions here. For the size standard, if you have a foreign affiliate, do only the US employees count?
No. Foreign employees count for the size standard, but they don't count for the calculation of forgivable expenses.
And as far as that 300 employee limit go, can you talk a little bit about what's meant by affiliation waivers apply, that comment?
Yeah, so affiliation waivers just strictly means that if you are a company that starts with NAICS code 7.2 or you are a franchise, then that affiliation rule does not apply to you, but everybody else, it does apply.
Okay, perfect. A couple little math questions here. So somebody's down 24.6% in a quarter. Can they round up 25% for eligibility purposes?
I'm going to say yes. Certainly that it doesn't, it gives you a whole number. And so if you round that up, make that a whole number, you are good.
I think confirming it with your advisors is a good idea.
Right. And just being upfront with the lender about it as well.
That's right. That's right. All right. If somebody has internal financials for their third quarter, which shows more than a 25% reduction, is the expectation that they'll still need to provide bank statements as backup for that?
Well, I mean, so it's you only have to provide one of those, right? And so, the question then becomes if you report to the bank, because some people, report financial statements and you give them to the bank anyway, and then you're like, well, I'm not there on an accrual basis, but I can convert it to cash basis. Just again, you want to be upfront with the lender. If the lender, sees those internal financial statements, then you want to be consistent. But otherwise, you don't have to provide both. It would just be one of those.
Okay. All right. And then I'd like to clear these gross receipts questions. So we had another one come in during your comment on cash versus accrual, and somebody had a question going in the opposite direction of that, Mike. So if cash basis is more favorable for qualifying, but they file on an accrual basis, can they use cash basis?
Well, I mean, again, it's fairly vague. And then let me bring up the definition, and then essentially it's essentially in whatever form received or cash in accordance with the entity's accounting method. Now, so you don't want to be in a position where it's just like everything's on an accrual basis, but all of a sudden I'm going to start using the cash basis, to try to to try to get to the 25%. But if you use both, I believe, for one reason or another, like, you keep your books on accrual method, but you file taxes on the cash method, you should be able to choose that.
Okay. We've got a group of questions on the forgiveness process. So I'm gonna just kind of group these into one question for you.
Mm-hmm.
Cover them as you see fit. So, will the PPP2 draw be forgiven in the same way that the initial PPP was forgiven? That's
Yeah,
one.
and again, for PPP1, you have up to 10 months after the end of your covered period to file for forgiveness, and then the process is essentially right now your lender, or whoever's managing the loan has a portal for you, and then they have the information that you need to upload. Obviously, if you're over 2 million, there's additional information that you need to provide than if you're under 2 million. And so it's up to working with your lender to submit the application. They will tell you whether they approve it or not. And then they will send it to the SBA with if they approve it with a recommendation for forgiveness. And then it's up to the SBA. If you're over 2 million, you might face some additional scrutiny from the SBA. If you're under 2 million, then generally I think that the SBA will look to the lender to do most of the due diligence.
Okay. As far as the second draw information goes, do you have to use the same information for the second as the first, or are they looking for expenses that were beyond what were asked for in the first? So as the example that was given by Regina, their payroll was mostly covered, but not their rent, utilities, and loan repayment.
Yeah, so it's the same logic that you would essentially use the same categories. The idea is to kind of maximize what you're spending on eligible expenses. What hasn't changed is that 60% or more, at a minimum 60% has to be spent on payroll expenses, so you can have up to 40%. They just brought in the category because there were still a lot of people that weren't reaching full forgiveness. At the end of the day, the SBA wants this to be a grant program. They don't want this to be a loan program. Lenders don't want this with loans on their books. And so they're looking for ways for you to maximize it. At this point, they have enough outs where the only way you do not get full forgiveness is if you just didn't spend it on eligible expenses, which is why they expanded the categories to help you get there.
Great. Do we know whether the $2 million audit threshold is cumulative for PPP 1 and 2 yet, or whether they're separate?
So it is. So what this kind of gets into is corporate groups, and so on a corporate group model, let's say you qualify, with all your affiliates under the threshold, and then you can file then separate PPP loan applications. The corporate group threshold was maximum $20 million. For round one, it's $4 million for round two. Again, this kind of gets into affiliation rules, which can get a little hairy. But let's say you're in one of the excluded affiliation groups in restaurants, and you have a huge restaurant group, and you have a whole bunch of PPP applications out there. Technically, you should be up to only $4 million. But again, there's different variations in control and ownership that kind of get into a whole different area. But generally speaking, on a cumulative basis, it's $4 million for PPP2, $20 million on PPP1. On the affiliation, on the excluded entities, it gets, there might be some leeway to extend past that.
All right, and then as we've been doing questions, we've got a couple of ERCs that have come in. So can ERC be used to cover payroll expenses for employees that make over 100,000, in particular that share in excess of 100,000 that is not taken into account in the PPP?
Yeah, I'm not aware of any limitations on, employee thresholds for ERC. But certainly, you cannot. So I guess the question being that those funds would be excluded for PPP. So then, would they be eligible then for ERC? Possibly. Again, there's companies, and we don't do the calculation of eligible wages. There are certainly companies that will do that for you, but I'm not aware of any limitations on wages for ERC.
And then it looks like there's also a little confusion in the marketplace about the threshold for the quarter-over-quarter reduction. It sounds like folks have heard a 50% reduction for the ERC. They've heard 20%. Any guidance on that?
So the 50% threshold was for ERC1. The 20% reduction was for ERC2. So again, to be eligible for ERC1, meaning in 2020, you had to have a 50% reduction. For 21, meaning, they extended the program for Q1 and Q2, you only have to show a 20% reduction. That 20% reduction is comparing Q1 21 versus Q1 2019, and then Q2 21 versus Q2 2019. Reason being that if you did Q2 21 versus Q2 2020, a lot of people wouldn't have that 20% reduction. So they use 2019 as the benchmark.
And Mike, it looks like the years are definitely something that's tripping folks up here. So let's talk about that for a minute. Like, here's an example from Celine, who was advised on the PPP-1 loan, who used payroll from 2020, but now understands that she could have utilized 2019, which was higher. Is it okay to use 2019 for PPP-2?
Yes.
Yes, and then open at the same time PPP-1 to increase the loan.
Yeah, I mean, again, the reopening of PPP-1, they gave specific examples of what qualifies, but again, this necessarily, you would have been eligible for a higher amount if you used 2019 for PPP-1. You just need to make sure that you would have utilized all your PPP-1 funds in 2020 before getting, meaning that you would have spent it and you can take credit for it. If not, you would have an outstanding balance on PPP-1, and you can't have that, in order to get the second draw.
Great. All right, let's talk a little bit about the urgency here, because that seems to be a topic that's on top of folks' minds. So I guess, do we know how much is left to be distributed, and is there an urgency to apply for these, given the amount that is?
Yeah, last I checked, I think there's $35 million in loans that have been issued. And again, that there's some lag behind this. I think it's to 285 is the total amount. Without, having a lot of the larger companies take $10 million chunks, I think that this program is going to last a bit longer. But again, I don't want to say that it's, how long it's going to last. I would say that you would want to get your application in the next week or so in order to avoid it. Now, if you remember back, the first part of PPP-1 lasted about 2-3 weeks. And then when they expanded it, it went until August, and there was still, a significant amount of unused funds. So I don't know it's going to go as fast as the first part of PPP-1, but again, I don't want to leave people thinking have not have a sense of urgency and get complacent, and all of a sudden you have until March 31st to file your application for both PPP-1 and PPP-2. However, I don't know that there's any guarantee that the funds will last till then.
And any recommendations on submitting applications for the second PPP before submitting forgiveness on first?
It doesn't matter. I mean, you have up to 10 months, to file for forgiveness for PPP-1. So certainly, it's a much longer runway. So it doesn't. I wouldn't wait, file for PPP-2, because again, there's a little bit more urgency for that than for forgiveness for PPP-1.
Okay. Mike, there are some more sort of like technical company specific questions that are queued up here. So what I'd like to suggest, we'll go through a couple more as we close in on 12:45. But if we don't get to your question in the next couple of minutes, I do recommend reaching out to Mike directly. His email address is on the screen. And we can certainly get these questions.
Yeah, and I can take a look at them. So, one question is, what's the difference between the 3508EZ and the 3508 form. So that's essentially the forgiveness forms. So there's a couple different forgiveness forms that you can use. There's, if you're on loans under $150,000, it's a very simplified form. It's just certification information. Again, you have to spend it correctly. You're certifying to that, but you don't necessarily have to provide that information. There's the EZ form. You have to be careful. There's 3 criteria for the EZ form that you have to meet. And again, that takes away the full-time equivalent reduction and the reduction of wage rates in excess of 25%. But you have to look carefully at those 3 criteria for the EZ form, and then you have the normal form, which factors in full-time equivalent reduction and the other reduction, which is you couldn't have reduced your wage rates for your employees when comparing the first quarter 2020 to the covered period.
All right, let's knock out these anonymous attendee questions since we can't reach out to them afterwards. So if the loan amount is less than 100,000, is that automatically forgiven, or do you still provide required documentation? The bank hasn't taken it off this person's statement.
So, I mean, automatically forgiven. You still have to file the form. It's a simplified form, and so you don't have to provide much information. But we have heard from lenders that they still ask for some information, even though they're filing a simplified form, and ultimately it's up to the lender. But according to the guidelines, you do not have to provide any additional forms. Some lenders might take a different interpretation of that.
And then can you just reiterate the test on ERC1? Is it annual 2020 versus annual 2019 by more than 50%? Somebody's asking to repeat.
Correct. Yeah. So it's quarter, I believe it's quarter over quarter of that same quarter, 2020 versus 2019. And it's 50% to be eligible. And then, each quarter through the time where you cross the 80% threshold, you are eligible.
All right, perfect. Let's see here. So the affiliation rule.
Yeah, even if the majority of the interest. So leave that up, Steve, real quick, just so I can read it. Even if the majority of interest in various levels is not the same, there seems to be some trigger of control. So, again, on the affiliation rules, they talk about even if you don't have 50% or more ownership, is it the same group that controls it? Is it the same group of family members that control it? And they have the same economic interest? Is it the same board members? Is it the same board that controls it? There's varying factors on there, and there is an SBA. There's like a quick 2-pager that gives you an outline of it. But again, that kind of goes into some legality of it. So it's certainly something that I would check, with legal counsel that's familiar with these SBA matters to see if you're on safe footing. All
right, perfect. Mike, I think that's going to be it. I think we'll wrap there. So Patrick, Liz, Carol, Mary, Brian, and Lisa, we can certainly touch base offline to make sure that we get those questions answered for you. Mike, any parting words before we close it out?
No, thank you, everybody. Listen, this is it's a living, breathing thing. It changes daily. Usually each day that we do a webinar, new information comes out. So far today, I don't think any new information has come out, but it is changing rapidly. So, stay tuned. We have a COVID response center on our website where we, keep everybody up to date. And, if you're not on our mailing list, please sign up and it will certainly disseminate information as it comes available to us.
And folks, love to invite you to next week's session. Again, same place, same time, same day, Thursday, February 4th at noon. We'll be joined by Joe Cashel talking about restructuring and turnaround. So if that's relevant to you and a topic that might be of interest, please join us for another session on February 4th at noon. Sign up for our mailing list. Look at our replays. Thanks so much for joining today. Look forward to talking with anybody else who has questions offline, and wish you all a great end of your week and a terrific weekend. Thanks again.
Yeah.